Welcome back, dear learners. Before the ad break, we did bad debts, and we were able to record the bad debts in the general journal. We also did the general ledger together with the accounting equation. What I have here with me is bad debts recovered. What are these bad debts recovered? Bad debts recovered is a payment received for a debt that was written off as irrecoverable previously. So, what happens is when an account is declared irrecoverable, we consider it a bad debt. And then that account is written off. It then happens that the individual or the business that was owing us for that account that we wrote off later comes on. It can be in the next financial period then. Then they later come on. Then they say, we want to pay the account that we were not able to pay in the past. The moment they are able to pay that account that they were not able to pay in the past, it is then considered a bad debt recovered. So first, it has to be written off as a bad debt, and then we can say in the next financial period, then the individual or the business comes and they say, we want to pay. Then we consider it a bad debt recovered. So they now come with a payment, then we receive that payment for a debt that was previously written off as irrecoverable. That is how we then have a bad debt recovered. Very important that you get the difference between the bad debt and the bad debt recovered. We will now begin to record in the general ledger. And the first account is bank. It says, debtors control 100,000. Bank 7,000, and then bad debts 500. An amount of 250 was received from Baloyi, a debtor whose debt was previously written off. The transaction has not been recorded. So we have Baloyi, who is a debtor that was previously written off, and then they have now come to say, I want to pay my account, and they have paid 250. So what we do is that amount must be recorded first in the CRJ. Therefore, that is why you see it in the bank account on the debit side here. The amount received will come here and it will be bad debt recovered 250. So we come to our bank account, in our bank account, and we are debiting the bank account with bad debt recovered 250. And then we come to bad debts recovered, and then we credit it. Why? Because this is now an income account. So we credit it with bank, and we say 250. Someone is asking, but Mr. Simbi, why did you not adjust it to debtors control? Here's the answer. The moment an account is written off, it is taken out of our debtors control amount. In other words, the moment it was previously written off, the writing off part simply means they took it out of our debtors control. So this amount of 250 is no longer part of our debtors. When an account is written off as a bad debt, it is taken out of our debtors control amount. So when he is then coming to pay, it can no longer affect our debtors control amount. So that 250 does not affect our debtors control amount. However, it affects our bank and our bad debts recovered only. Very important for you to note, the bad debts recovered will not affect your debtors control, but it will affect two accounts. Number one, bank. Number two, bad debts recovered. How then does it affect the accounting equation? On the accounting equation, you remember it says an amount of 250 was received from Baloyi, a debtor whose account was previously written off. So here is a debtor who was previously written off coming now to pay. So which account do we debit? We would therefore debit bank. We debit bank, and remember bank is an asset. When you do the accounting equation, it is very important to know your accounts. And in this case, we're coming to our bank. We're considering that our bank is favorable. So we're coming to our bank and we're going to say plus 250 because we are receiving money from Mr. Baloyi. Mr. Baloyi is giving us 250. So we come and then we debit bank. Once we debit bank, our assets increases. So you see it's a plus. These signs are very important. If you say plus, that means your account is increasing. If you say minus, that means your account is decreasing. So the moment Baloyi pays us, we come, we debit bank plus 250. And the next one is we credit bad debts recovered. Remember what I said, it does not affect debtors control. It never affects debtors control. This is bad debts recovered. So we'll come here and then we credit bad debts recovered. Earlier on, I told you that bad debts recovered is income. So it therefore means I'm crediting an income account. That means my income is increasing. So I'll come now to my owner's equity and then I'll say plus 250. Why plus? Because bad debts recovered is income. Bad debts recovered is income. So I'll come to my owner's equity plus 250. It is very important, dear learners, that when you do this, you get to understand which account is affected. And remember, the signs are very important. Another thing that is very important is when a particular account is not affected, for example here, my liabilities are not affected, therefore I must put a 0 to indicate that there is no effect on my liabilities. What is affected is my assets as well as my owner's equity, but my liabilities, it remains 0. Dear learners, it has been lovely having you in my class today when we spoke of bad debts and bad debts recovered. I hope to see you again soon. It is goodbye from me.